Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is David Kuo, founder of The Smart Investor, and he's coming out of Singapore. David, as always, great to have you every Friday.
Thank you so much, Brian. Yep.
Now, David, before we get your insights, let's take a look at how crypto markets are performing, and then we'll take a look at regional markets. Now, Bitcoin is at 64,918. It is up 0.43%. Ethereum is at 4,778.93. It is up 3.06%. Now, if we look across the regional markets, we've got the ASX 200, which is at 7,772.1. It is up 0.92%. The FTSE Singapore is at 335.85. It is unchanged. The Hang Seng is at 25,276.62. It's up 0.17%. The KLSE is at 1,527. It is up 0.54%. The Kospi is at 2,968.56. It's up 1.49%. The Nikkei is at 29,561. It's up 0.97%. And rounding up the numbers, we've got the Shanghai Index, which is at 3,532.82. It is marginally up at 0.1%. Now, David, what's your view on how markets have performed this morning?
Well, I think markets right now are just sitting on their hands a little. The Dow was down a bit last night, and so I think Asian markets being slightly in the green is probably a relatively good sign. And I think what we'll find with the markets, Brian, is that it'll be two steps forward, one step back most of the time. But I think we'll be inching higher towards the end of the year. And I think next year is going to be even better than this year.
Now, that's optimism that oozing out of you, David. But, talk about optimism. We basically had some really good results out of the Alibaba Singles or the Singles Day event. They had a record sales. And that's impacted some basically Chinese stocks that are listed in Singapore, in the US. So you have the likes of JD.com, which is up 8.31%. Pinduoduo, which is at up 7.35%. And of course, Alibaba itself is up 2.37%. Do you think that that's kind of the barometer of the fact that investors are starting to warm up to the fact that despite all the negativity around these stocks, that China is still the long-term play?
Well, I think there's a couple of things. The first one is that many of these stocks were hit pretty badly by the clampdown in mainland China, and investors took their money off the table and said, we'll just wait for some clarity from what is going on in China before we start putting our money back in. So on the one hand, you have these stocks that are looking relatively cheap. And so when you have cheap things, as you well know, Brian, I mean, if there was a restaurant or a mamak stall somewhere that was selling mee goreng at half the price, there'll be a lot of people queuing up outside simply because it is cheap. And that is pretty much the case with regards to these internet companies. But I don't think we should lose sight of the fact that there is a clampdown going on in China. And in the case of Alibaba and JD.com, what is quite interesting is that they were reporting figures on their Singles Day. And I don't know about you, Brian, but I completely forgot about Singles Day this year. There wasn't that kind of fanfare this year as we had in previous years, where there was a big show about Singles Day happening. It completely passed me by. But I think in terms of the numbers, Alibaba found that their activity increased by about 8%. JD.com did a little bit better, but there wasn't that sort of hype that we saw in previous years. And maybe people are saying that, yeah, these companies are okay, they're doing all right, but let's not forget that China is clamping down on many of these companies, and they don't want to see conspicuous consumption. In other words, China wants to ensure that there is this common prosperity, and they don't want people going out thumping their chests and saying, oh, I bought this, I bought that on Alibaba or JD.com. They want to dampen things down a bit. And that seems to have sort of affected these companies. We don't see the kind of gung-ho spirit that we had in the past, and it is a lot more subdued than it has been previously.
And I think that again, you got to cut the cloth to suit the situation, and that's exactly what they've done.
Well, I think they have no choice, because let's not forget that China pulls the strings. And if China says that we don't want you guys going out there telling everybody that sales were up 40%, 50%, and that there were lots of people out there buying stuff. And China recently sort of said, let's not go out and cheer the fact that these companies are hitting record highs, or rather their sales are hitting record highs, but let's look at the underlying science behind these companies, and that your technology is actually quite strong. So there seems to be a change in rhetoric in China. So are these companies going to be around, in 5 or 10 years' time? I think they will, but I don't think they will be around in the same way that we see them today. They're not going to be scaling higher highs all the time as far as their businesses are concerned, but they're going to be towing that government line and try and sort of spread the wealth a little. There was already some talk, that some of these companies were saying that the second and third tier cities were buying more stuff rather than those big cities that we always hear about, the likes of Shanghai and maybe Beijing and maybe Guangzhou and those kind of places, whereas they're saying that, we seem to be spreading the wealth a little bit more now, and it's those lower tier cities that are buying most of the stuff. So there is a change in sentiment.
Now, on the flip side, I want to bring us closer to home. Malaysia's GDP number came out at negative 4.5% year on year in Q3. That's a pretty bad number by any book. What's your thoughts on that, particularly because there were low base effects from last year?
Well, I think if you compare it to last quarter, it is a huge disappointment. I mean, growth was in the double digits in the last quarter. So this quarter to actually sort of get roughly around sort of between 4 and 5% shrinkage is kind of acceptable. So take the 2 quarters together and you probably don't have that bad a number. But it just goes to prove that this virus is still around. And whenever you get restrictions, you are going to get lower consumption in terms of household spending. And that is one of the big drivers in Malaysia. If you stop people from going out and going to the stores, they aren't going to be spending money. If they don't spend money, then that velocity of money is going to start slowing down. And when that happens, you're going to get some kind of economic contraction. So just as stock markets are taking 2 steps forward and 1 step back, I think we can sort of say the same about economic expansion. It was, more than 2 steps forward in the last quarter, and they've taken 1 step back in this quarter. So that seems to be what's happening right now. So we just have to accept the fact that it's going to be a very slow train to recovery. It's not going to be all guns blazing, and we're going to be back in pre-pandemic levels straight away. It's going to take a while, Brian. And I'm cognizant of the fact that as an investor, I have to be patient, and I have to bide my time just like everybody else.
Now, David, as always, thank you very much for coming on the show, and thanks for your insights.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, the founder of the Smart Investor, and he's based out of Singapore. Now, on Biztech's Asian Midday Marketwatch, I'm Brian Fernandez. Please check out this video and podcast on our various social media platforms, as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thanks again for tuning in.